Thanks everyone for joining us today as we discuss planning for the new tax year upon us already. We are hopefully going to consider some of the recent changes that are coming into effect for this tax year, highlight some of the potential risks if planning isn't there and haven't been considered, but also hopefully show that there are some good opportunities coming into this tax year for you all to hopefully be able to benefit from. I'm Chris Hallam. I'm a Chartered Financial Planner at Moore Kingston Smith. Today, I'm joined by Katie Shaw. Morning, Katie, who is a director in our tax team. So hopefully together we can cover both angles from a financial planning perspective, but also from a tax perspective, which is obviously key in all of the work that we do. A little bit of housekeeping for today. Format for the webinar, Katie and I will be putting questions to each other on how best to plan in this new tax year. Thank you to all those who have submitted questions before the webinar. It's great to see sort of everybody already starting to think about this. We'll hopefully cover those today. For anybody else, you should also see a Q&A box at the bottom of your screen. We love for these sessions to be as interactive as possible, so please jump on that Q&A, ask questions as we go through. We will try and address them as we go along if there's time. Anything we don't come to, we're always happy to sort of pick up the conversation afterwards, and we'll make sure we come back to you on those. So just at the bottom of your screen, ask away as we go through, and we'll absolutely try and answer them and make it as relevant to everybody on here as possible. So let's get started. Katie, morning, hi.
Hi, Chris. Hi, everybody. Thanks for joining, everyone.
So we normally see advisors talking about end of tax year planning. So I suppose a good place to start for us is why are we doing this now? Why are we doing this at the start?
Yeah, thanks, Chris. That's a really good question to kick off with. So tax planning is usually focused at the end of the tax year, but I think there's much more value in considering it now. And the reasons for this is that it's too late to plan at the end of the year once income and once gains have already been generated, and the opportunity has potentially been lost to rearrange ownership of assets or to transfer income sources to, say, spouses who may pay tax at a lower tax rate. And related to this point is that if you're planning on carrying out a transaction, I always think that generally it's worth doing it in a known tax environment if you were going to carry out that transaction in any event, especially if that known tax environment is quite favourable. So, for example, capital gains tax rates at the moment are historically low. So if you're going to carry out a transaction that triggers a CGT charge, then you might want to consider doing that and banking that CGT rate now. And similarly, if you're going to make a gift, and that gift is one that starts that 7-year clock for inheritance tax purposes, then clearly it's better to do that sooner than later. Secondly, the prospect of an incoming Labour government might prompt clients to think about taxes now and what a potential change in rates might mean for them personally. Labour haven't made any major tax announcements yet, bar the changes for non-doms, which was slightly, Jeremy Hunt stole Labour's thunder on that to a degree, and the VAT changes for independent schools. But I think we would generally agree that taxes are unlikely to decrease significantly under a Labour government. So it's worth considering your tax position in that context. And just more broadly, finally, I think planning ahead and being proactive arguably results in better financial well-being and that sense of being in control. Or put simply, just having a better relationship with your money for the longer term.
Yeah, I think that's a good point from a planning perspective, where we're always helping clients. I think the comfort of knowing what you're going, knowing what the plan is going forwards and what you're trying to do makes it a lot easier for people to just get a little bit more comfortable with what's happening over the year. I think I'd also add another point to that from an investment standpoint. So there are a couple of things that sort of help when you're planning early from this, because a lot of this sort of session will be speaking about investments or pensions that we can make. And we talk a lot to clients about time in the market when it comes to investments. And it's frequently been shown as probably one of the most important drivers to actually long-term success in any investments you're making. And quite simply, being able to make these investments sooner, giving you longer in the market for capturing that potential growth is going to make a big difference. Certainly this year, but also if we consider this is planning for this tax year, but actually the having the discipline of doing this early as you go through many tax years, maybe on the route to retirement, then actually you've got a long time for these sort of benefits to compound over time. There's probably one other point I might just add, where planning at the beginning of a tax year also allows you to sort of spread your investments over time. So giving you the ability to make maybe monthly contributions into ISAs or into pensions instead of needing to make one big lump sum at the end of the year. And that can make it a little bit easier for clients to manage from a cash flow perspective, but it also helps a little bit with risk when you're drip feeding into investments. So sort of helping smooth out the volatility as you go through and making these investments. We've had quite a few budgets recently, and actually there's possibly been some more changes in those than maybe historically we've become accustomed to. I think maybe before we go on to some ideas and what we can do planning going forwards, Katie, do you want to give us a maybe a little bit of a recap as to some of the changes that have come in and just where the starting position for everybody is in this new tax year?
Yeah, sure, definitely. Yeah, it's hard to keep up with some of the changes. So just to run through certain ones that might not be on everybody's radar because they're new, say for this year. So the capital gains tax annual exemption is now £3,000 per individual, and that's quite the decrease from just over £12,000 per person only just a couple of years ago. So yeah, so just £3,000 annual exemption for CGT now. There's a new 24% rate for capital gains tax on sales of residential properties. So not for main homes where full main residence relief is available, but say on sales of second properties or buy-to-lets. And the 24% rate applies for higher rate and additional rate taxpayers. And that's coming from this April. In relation to investment income, so individuals for this tax year, they've got a tax-free £500 dividend allowance, and that £500 sits on top of the usual personal allowance of £12,570. There's also a separate personal savings allowance of £1,000 for a basic rate taxpayer and £500 for a high rate taxpayer. And again, that savings allowance sits on top of the normal personal allowance. So you can make some amount of savings tax-free. Unfortunately, if you're an additional taxpayer, you don't get a personal savings allowance. So that's not available. Also taking effect from this April were the various decreases in national insurance contributions that were announced in the last budget and last autumn statement, but they only relate to employment income and self-employment income, so it's not relevant to returns from investments. Just to recap where we stand currently on pensions, so the annual allowance for pension contributions, that is currently £60,000 per person per year. You only pay a tax charge if you go over this amount, or the tapered equivalent if you're a high earner. So if you are a high earner, you get a minimum of £10,000 that you can contribute annually into your pension, or if your earnings exceed a certain amount, you get a tapered allowance of between £10,000 and £60,000 if your income exceeds £260,000. And then the overall pensions lifetime allowance, that has been abolished from this April, meaning that the amount that you can build up overall into all your personal savings is now uncapped from the previous limit of just over £1 million.
Yeah, it might be worth at this point just sort of jumping in with a little bit on pensions, as that's, I think, probably one of the biggest things we've had clients asking us recently about some of the changes. As has typically been the way when it comes to pension simplification, it's never really led to anything that actually makes things simple. And unfortunately, in this case, has largely just replaced some acronyms with some new ones. So where we've lost the lifetime allowance from previously, which we'll go on to talk about a little bit some of the opportunities that leads to. But it has been replaced with the nicely named sort of lump sum allowances, which is effectively what used to be tax-free cash, and the lump sum death benefit allowance, which is set at the old lifetime allowance limits. But there's some new jargon and things coming out, which actually is going to be new to a lot of clients who, I think, fair to say, over the years have had to relearn pensions probably a good few times, and we're sort of there again now. So just being mindful of some of these sort of new terminologies that are coming through and will have impacts.
So Chris, so what would you say, if you just started from the basics, what would you advise individuals to consider?
Yeah, so when we talk about sort of tax year planning and what to look at, we sort of order things from the simple good housekeeping going through to actually some of the more complex areas and some of the more potentially technical points for certain clients where it's going to be relevant. The first one we always tell clients when it comes to making investments and tax planning for the year, make sure you're trying to use the allowances that you have available to you. So the really obvious one here is ISAs, and then pensions alongside that. Pensions certainly for that long-term retirement planning. ISAs, actually a lot of people using it for that long-term planning as well, but potentially with the ability to be drawing some of these funds sooner if there's a need to do it. Often, I think overlooked with clients sometimes is considering planning together as a family unit and certainly with a partner or spouse. Actually, where you can be sort of investing in different people's names and effectively doubling these allowances. That's a really, really important sort of thing to consider. ISAs as a starting point. It's a case of, this is a product that effectively takes any tax worries off the table. Now, when the ISAs first came out and low levels, actually a lot of people thought it wasn't particularly worth doing. Actually, now when you're up at an annual ISA allowance of 20,000 per person, potentially sort of 40,000 as a couple, it's going to put you in a position, especially if you start early, where you can start sheltering very significant funds in a completely tax-free environment. Now, that's tax-free growth within the ISAs, but also importantly, being able to withdraw money from the ISAs without needing to worry about any sort of tax consequences coming off the back of it. So that is a very, very good starting point. Take that tax issue off the table for what can become a very significant amount of funds. Actually, we're already talking to lots of people at the moment, ISA millionaires actually becoming more and more frequent, and certainly going forwards as the allowances continue on, that's only going to become more and more sort of the norm for people who have started early and have started sort of sheltering these assets to just take away any sort of tax issues there. The other one for people with children out there, junior ISAs, a very, very useful tool to start saving for your children. £9,000 a year annual allowance on that now per child. So actually the ability to really put a very good sum of money away for your children. Typically we see it maybe building up a pot to help support them through university, maybe building up a pot to help them get on the property ladder at the beginning, which we all know is sort of a primary goal and certainly a concern for a lot of people and parents. The next obvious one here, slightly longer term and typically used around retirement, but pensions. Now, there's a huge amount written about pensions and, frankly, not all of it positive. What I'd say is largely ignore a lot of the criticism that you occasionally hear. Pensions are still without doubt the best starting point for saving for retirement. The tax benefits you have on the way in still very attractive. So whether it's basic rate tax or above sort of 20, 40, 45% tax relief on contributions you're making going in, really allows you to make a big sort of jump and a big tax saving, which over the years to retirement really, really helps build up that pot. almost uniquely to any other sort of product or savings vehicle which doesn't allow it. Also, some benefits outside from things like inheritance tax and estate planning, where actually your pension is going to sit outside of your estate for those purposes. So, whilst you obviously hope that it's going to be available for you to draw in future, actually you're not losing any of these funds. And actually, from an estate planning perspective, is a really, really attractive vehicle for that.
Yeah.
We have a lot of higher value clients as well who are potentially using these as estate planning vehicles now and inheritance tax planning vehicles, where it's a very easy way to shelter assets away from inheritance tax, and knowing that you're just steadily making things more attractive. A couple of things to sort of note that may have changed for people's situations sort of going forwards. Firstly, the new allowances of 60,000 up from 40,000, but also the change in the income levels behind that before you start tapering. Now, that's brought a lot of people back into scope of being able to make, potentially very sizable pension contributions, who in the past just simply weren't able to do. Even for those very high earners, the allowance where you're fully tapered, so you're fully reduced on the allowance, that's now gone up to 10,000 instead of 4,000. I know a lot of people are still sort of going through doing the regular 4,000s. Actually, you now have that opportunity to increase that. Yes, it's not a huge increase, but actually over the years, this is still going to help you build a more sizable pot than you were able to before. I will flag the obvious sort of question in the room here when it comes to a Labour government. Katie mentioned it earlier. We have a lot of conversations with clients, and there is still a lot of uncertainty around pension contributions, and in particular around lifetime allowance, and what Labour may bring in if they get to power sort of end of this year or early next. It is likely something will change. Exactly what that is, I mean, we did a long webinar on a potential change of government recently. It is uncertain, but the certainty around this is that actually the opportunity is here now, and actually may not be there in sort of 6 months' time if there are changes to this. So making sure you're taking those opportunities now, actually, because you may find that some of these are lost.
I think the inheritance tax point on pensions is a really good one, Chris, because years ago we didn't tend to speak about pensions in the context of inheritance tax planning, but I think with the freezing of the nil rate band and more people are now paying IHT, pensions is much more in the spotlight in terms of estate planning for inheritance tax purposes. So I think that's a big one to consider, especially with the new abolishment of the lifetime allowance. Just a question that's come through, just on British ISAs. Is there any update on those, on the British ISA that was recently announced?
Yeah, so for anyone who didn't watch what was quite a lively budget, I think it's fair to say, and probably the last one of this government pre-election anyway. Announcement of a British ISA, and now this is only going into consultation at the moment, so it's not been sort of formally announced or launched by any means, but announced that there will be a new £5,000 a year annual allowance for a British ISA. Idea being that this is hopefully going to help drive some investment into the UK market and into UK equities. There are a lot of experts arguing both sides onto whether there is value to this. We'll have to wait and see a little bit on exactly what the details are. But to an extent, if it does come in, it's going to lead to some more planning for clients. But at the same time, an extra £5,000 allowance, 10,000 for a couple, is a meaningful uplift on an ISA allowance, which has been static now for a very long time.
So if over and above pensions, ISAs, so if you're already ticking those boxes, what else could you do? What else is there to look at?
Yeah, so there's a few sort of more complex areas that we consider for clients, and a few actually that are just overlooked and not necessarily considered. So when going through Katie discussing the new tax allowances and tax rates which have come down, we certainly with capital gains have seen a big drop from 12,300 of an allowance for capital gains each year, now all the way down to 3,000. Now, that's going to make a lot more people or catch a lot more people who will now be subject to capital gains tax, where actually in the past it's never been an issue. Now we see clients, even if they're not necessarily selling assets, but just from general managing of their investment accounts and investment decisions within those, actually are going to start getting caught in a tax position that they've never had to think about before. And that is going to be quite a big change to how people have had to structure their portfolios in the past, and actually are now really going to have to consider this going forwards. There's a few things to help there. Consider actually tax wrappers around this that you can use. So we've discussed pensions, we've discussed ISAs, actually things like offshore bonds, for example, longer term investments that allow you to invest sort of lump sums or potentially regulars into a structure which is going to allow these funds to grow and for you to be able to make changes within these portfolios without needing to actually worry about the tax consequences from doing that. There's also, when we talk about investment accounts with clients, there are different investments that you can make within those accounts, which are also going to help sort of manage this on an ongoing basis. So the obvious one that we're doing a lot with clients at the moment, where in the past they may have held an investment portfolio with multiple lines of maybe individual stocks or multiple lines of individual funds that then subsequently need to be traded in and out of, so that you're continuing to have a current and up-to-date portfolio. And that's hugely important in investment management, is to make sure it is being updated as frankly the world changes, which it certainly has in recent years. But being able to change some of those structures into maybe considering more fund-based solutions, where actually a portfolio is wrapped within a fund, you're still benefiting from the management behind it. You're still benefiting from being able to keep an up-to-date portfolio. But actually all the changes can be made within that structure. So on an ongoing basis, you're not suffering capital gains tax potentially every time you want to make a change in the investment allocation or switching out of one investment into another one. So that's a very good way of giving you a little bit more control over how to do it, and then being able to, on an annual basis, sort of use some of those gains. 3,000 allowance, it's not great, but it is still there. It's still something that you should be using every year. Certainly with partners where you've got 6,000 allowance between the two of you, certainly sort of using all of that together. And in any one single year, these things might sound small, but actually when you're doing this sort of planning over the course of 5, 10, 20 years plus, actually the difference in taxes is very, very beneficial when you come to the end of it. There's also a couple of other more, I suppose, niche products for some people. So we talked a lot about venture capital trusts, enterprise investment schemes, so VCTs, EIS investments. Now, for those that haven't come across these are typically used by clients where pensions are no longer an option. So maybe where they're already maxed out on contributions, they may have completely tapered allowances, so can only put 10,000 in, but actually want to save, beyond that and further. And VCT, EIS investments, SEIS investments, which sort of share similar rules, a way of being able to invest and get some tax relief. So typically 30% income tax relief up front when you're making these investments, and it's arguably it's not as high a relief as you would get through pensions. But when we're building a portfolio for, let's say, retirement is a very traditional one, actually being able to have all of these different pots as you go through, and very much with that eye on tax to help bring down those liabilities, is a very, very useful thing to consider. And we always look at these from a investment standpoint as well. So making sure that actually, these complement the rest of your portfolio, and actually quite frequently they do, because you're getting exposure into different assets and different areas that your traditional investments are very unlikely to be in.
Yeah, thanks, Chris. I mean, obviously, I don't advise on investments. That's your side. But my experience of reviewing several tax returns over the last few months, numerous amount of tax returns, what I noticed that there was a clear increase in the amount of bank interest showing on clients' tax returns and income from other cash-based investments that were reported. And speaking to clients, myself, for example, those who've recently sold businesses, many were happy to stay in cash over the last year or two. But with interest rates likely to decrease, what do you think investors will be doing next?
Yeah, this is going to be a very big trend for this year, sort of in particular. I mean, where we've had interest rates and certainly what people are able to earn, really going from maybe 1% a few years ago as to what you might be getting in a savings account. Actually now, you should be expecting sort of around 5%. And actually, I'd probably say at this point, if you're not earning around 5% on your deposits, it's probably worth having a conversation with us, because there are certainly places that you should be looking to consider that. But it's something where cash has looked arguably a very good investment for the last sort of year potentially, especially in relatively flat markets. But actually, long term, it's still not considered a suitable long term investment class. It is very unlikely to sort of keep up with inflation as we go through. So actually, one of the important things for this year will be, right, how what is my strategy for taking what might be a unusually high cash balance for me, and actually being able to sort of move that into a long term investment solution, which is going to earn above inflation, certainly earn above cash over the long term, and actually it makes a huge difference when it comes to maybe needing to draw down some of these assets in retirement or in the future.
Yeah, and on the subject of holding cash at the moment, or holding cash-based investments, for those clients who are looking to move away from cash and move into the markets over the long term, and perhaps structure their wealth tax efficiently through the use of, say, a family investment company, it's worth looking at that structuring now whilst they are in cash, because funding a tax wrapper or a family investment company is much more straightforward when it's done with cash. For those unfamiliar with family investment companies, it's essentially a company to make investments rather than investing in your own name, with the main tax benefit being that investment returns are subject to corporation tax rather than personal income tax rates. But they're quite tricky to use if an individual is already in the market in equities and funds, because to transfer it into a wrapper or into a family investment company, it would trigger a sale of that equity of the fund. So somebody with large cash deposits who's looking to invest longer term using a structure would be wise to start considering that now.
Yeah, I think that's a good point. I might actually just jump on a question whilst we're sort of talking about ISAs and structures and things. Question raised about having lots of different ISAs, and actually mentioning that it's potentially cumbersome. Something that I've found advising clients over the years that get lost quite a lot, and especially when it comes to people using cash ISAs, is that effectively people are opening up a new ISA every tax year. Now, where people have done that over a number of years, actually can very easily find themselves having 4, 5, 6, or even more sort of different ISA pots to keep track of. What I find is frequently overlooked is actually you can transfer between ISAs. And what we tend to say is, actually, where you can keep things simple, it's very worthwhile doing. You're never going to be able to, effectively track multiple different investment pots, and the same applies to pensions and investment accounts, where you can streamline these and have them in one, and it's possible to do with cash ISAs or stocks and shares ISAs. Actually consider, taking this opportunity now to actually maybe just streamline some of the structures that you've got and simplify some of the structures that you've got. Apart from anything, you're going to get a lot less post through the door, and it's going to be a lot easier to know sort of what you've got and what it's doing, and as importantly as anything, making sure it's actually growing and returning as it should. I think I might, while we're talking about tax returns, and Katie, appreciate you're off a very busy January sort of filing window and things. This year, I've mentioned with CGT allowances coming down, a lot more people are going to be sort of coming into that capital gains tax arena where they've never had to before. Are there any sort of quick tips or what people are going to need to do from a reporting side of this for people who maybe have never had to do a tax return before?
Yeah, that's right. So if you're already within self-assessment doing a tax return, it's business as usual. You just report your gain on your tax return. If the gain relates to residential property, then there's a separate 60-day reporting requirement and a separate CGT return for residential property. If it's not residential property and you're not already within self-assessment, then you do need to register for self-assessment, usually by the 5th of October. Following the end of the tax year. Or there is alternatively, but it's for more limited cases, there is a separate real-time CGT reporting service offered by HMRC. So that's usually for individuals making a one-off capital gain and they don't otherwise need to register for self-assessment. But yeah, it's just something to be aware of in terms of whether that it does trigger that filing requirement for you.
I know we've got a few business owners on the call. Now we do a lot of work with business owners on tax planning, sort of certainly in individual years, but also over the years. Katie, there's some people out there, business owners in particular, but also maybe some others in partnerships and things that have a bit of flexibility over some of their earnings. Is there anything that they can do from a tax perspective, certainly now, to sort of help?
Yeah, I think so. So in the case of owner-managed businesses or private companies, you have got the flexibility for determining how much you're paid and how. In reality, for company owners, they pay themselves a mixture of both salary and dividends. It used to be the case more so that you'd pay the lower salary topped up by higher dividend. But now, because of difference in corporation tax rates and dividend rates, the difference between the two isn't as much as what it was. But if you have got a business, say, with excess profits that you don't need for living purposes, then it would make sense to not pay a dividend or not pay as higher drawings and make, for example, a pension contribution instead. And that's because in the case of a company, you get a full corporation tax deduction for a pension contribution, and any employer contributions are not a taxable benefit in the hands of the director or the employee. There's also no national insurance contributions. So if you use an example of, say, £10,000 of excess profits, if you make a pension contribution, the net benefit to that employee or the director is £10,000. Whereas if you pay it out by salary or dividend or as a profit share, then that benefit is halved to around £5,000. So, you can see the immediate benefit there. Another example is realising capital gains instead of income to fund lifestyle. CGT rates are currently much lower than income tax rates. The main rate of CGT is 20% compared to the top rate of 45% for income tax. And it might seem counterintuitive to realise investments to fund lifestyle, but taking more of a holistic wealth planning approach, that can result quite often in less tax leakage overall across the individual's asset base.
I think that's a good point. And while we're talking about capital gains tax here and CGT, there's a saying as well, though, that I think considered and we love it in our sort of tax and financial planning areas, but don't let the tax tail wag the investment dog on some of these as well. And we consider too often, and a lot of the time, tax is quite emotional for clients. There is generally perhaps unsurprisingly, a desire to minimize the tax you're paying as much as possible. Actually, from an investment standpoint, though, that's not always the right thing to do. Actually, where we're looking at capital gains tax rates at the moment of 10 and 20%, certainly compared to income tax rates, actually consider on an annual basis, yes, it's not nice paying 10% tax, but certainly on a growth of an investment. And if you're able to, more actively manage the portfolio because of that, making sure that actually you've got a portfolio that is invested in the right way, and growth is always over the long term going to be sort of, your important driver in this. Actually consider, should I be realizing some capital gains on an annual basis so that I'm doing the right thing, so that I'm able to make the right decisions. So considering those long-term outcomes, even if short-term you are paying a little bit of tax, there's quite frequently long-term benefits. I know we've also got quite a few people who with properties on the call, certainly sort of buy to lets. Actually, frequently where things have gone over the last sort of few years, there's a lot more consideration into actually selling those properties. If that's the case, sort of this year, what are people considering, Casey?
Yeah. We've had a lot of conversations recently about clients potentially selling or considering selling their properties, investment properties, and understanding what their tax position is. The main thing is to work out quite accurately what your CGT exposure is upon sale, so that you can be informed in terms of whether to sell or not. There's many misunderstandings about certain reliefs and deductions, which can serve to reduce the tax bill quite a lot, and they tend to be around, whether main residence relief applies, what type of expenses can be deducted, or whether there's certain CGT rebasing rules, whether they apply. So if you're selling a property or thinking about selling a property over the next year, the things you need to think about is, well, what's the taxable gain and what's the CGT rate that applies? So it could be fully exempt if you've got full main residence relief, but it needs to be analysed in more complicated fact patterns. Or it could be up to 24% on the full gain in the case of a pure investment property. If you've got a property that qualifies as a furnished holiday let, which is defined, it's the defined furnished holiday let in the tax legislation, but usually it's like a well-used Airbnb or a holiday home, then the capital gains tax rules for furnished holiday lets is changing from next April, so from 6th of April 2025. So if you sell a furnished holiday let after next April, your tax rate will be 24% and not the current rate of 10%. So we are speaking to clients who are thinking about selling furnished holiday lets within the current tax year. Capital losses can sometimes be overlooked. So even historical losses, they can be carried forward indefinitely. So capital losses that you might have realised on any assets in previous years can be offset against gains in the current year or of future years. You could consider transferring a property into joint names if it's not already. So if you've got a spouse who's a non-earning spouse who has no other income source, for example, they can make capital gains of up to £40,000 at an effective CGT rate of less than 18%. That's versus 24% if all of that gain fell into the hands of the higher earning spouse. So that's worth considering. I mentioned before that deductions can be made to reduce any capital gain. So the usual ones are stamp duty tax paid on acquisition, estate agents fees, legal fees, but also capital improvements such as extensions or a new significantly improved kitchen, that type of thing. So those can be deducted too. What I would say, though, is HMRC look closely at expenses and deductions that have been made for CGT purposes. So quite often they'll want to double check that something is a capital expense and it's not a revenue expense and not a repair and a maintenance. So keep good evidence in that respect, and yeah, photos of before and after improvements are made, that type of thing. Yeah, because it does get looked into.
I think it's fair to say that's quite a complex area where, I mean, we have a lot of people at the moment who are going through this, and it is an area where I think advice is probably going to be particularly valuable and particularly beneficial. Certainly, anybody reading the news at the moment will probably sort of realise the importance of making the right decisions on these as well.
Yeah, that's right, Chris.
We've spoken a lot sort of going through about clients trying to, build their wealth, build their savings. Actually, what about clients who, maybe sort of later on in life and have a little bit of a different goal? Certainly when it comes to things like estate planning and inheritance tax planning, because that's important on an annual basis. But what should we be considering there?
Yeah, so there are various key exemptions for making gifts. So everybody gets an annual exemption of £3,000 plus a £3,000 carried forward from the previous year if you haven't already used it. So that's an immediately exempt amount on gifts to individuals. So you don't have to wait this 7-year clock. There's also smaller amounts for gifts in relation to marriage or gifts for any purpose. But one exemption that often gets overlooked that I'd just like to give a bit of a plug to, if you like, is the normal gifts out of income exemption. So essentially, there's no cap on the amount that can be gifted and it's immediately exempt, so no 7-year wait, provided that the gift is made part of an individual's normal expenditure. It's made from income, and that it left you with sufficient income to maintain your normal standard of living. And as I say, it's uncapped. So for those with quite high income levels, it can be a worthwhile exemption. It can be used to fund pension contributions for family members, so that you get the minimum of £3,600 each. So that could be gifted, say, to children or grandchildren. In terms of what constitutes income, it's usually pretty clear. But one point that I've looked into recently is historical income and at what point that turns into capital, because at some point it does, it changes the nature of income. There's no hard and fast rule, but generally HMRC consider a historical period about 2 years. So if you've received, fairly substantial amounts of income in the last couple of years, you could look to use that too. It can also be combined with gifting to a discretionary trust. So if you don't know who you want to benefit immediately, so if you want to benefit a wider class of beneficiaries and have some control in the form of a trust, you can use that exemption to fund trusts, as well as using the nil rate band as well, if that's still available.
I think with my sort of planning hat on here, one of the big things that is important to consider around this is we do a lot of cash flow planning with clients to actually help them understand also what is affordable making these decisions. So if we're talking about giving money away from income, you need to make sure that actually you're not leaving yourself exposed, because we would always consider estate planning or inheritance tax planning sort of secondary to a client's main goals of actually being able to look after themselves and fund their lifestyle, and certainly protect themselves later on in life if it comes to it. But certainly we don't want anybody putting themselves in difficult positions from this. So being able to have long-term understanding of what some of these decisions mean, actually that's very important for for you to be able to make those decisions on how much money to give away potentially, how to give it away, and actually what to do without leaving yourself sort of exposed as we go forwards. With quickly coming to the end, so I sort of thank you all for joining us. We've got a couple of questions which we haven't managed to get to. We will follow up to those afterwards. We will also be sharing a summary of today's calls for anyone that wasn't sort of scribbling down notes and tax numbers and things as we go through. We will follow up with all of those. What I'd finish on, a couple of takeaways from our side. So with all of this, the earlier you start planning for these things, the more opportunities you're going to have and the more options available to you as you sort of go forwards. But also just putting yourself in a position. We spoke about financial well-being. We spoke about having, confidence or comfort in the decisions you're making, and getting a plan behind this and getting an understanding as to what you're doing going forwards. Yes, this tax year, but also, making sure you're ready for all those tax years still to come, and whatever they may look like. Get that plan together, and have an idea of what you're doing going forwards. Of course, we're here to help with that, whether it's on the tax side, whether it's on the planning side, and they do very much go hand in hand. So I'm very fortunate to have the likes of Katie sort of supporting on a tax side as well. With that, I think I'll thank Katie for the insights today. Thank everybody for joining. Hopefully sort of, catch up with a lot of you afterwards and pick up any questions. Please feel free to sort of pop them through, but we'll follow up afterwards with a summary for everybody. Thanks to all, and have a good day.